Alright, so I just came back from the gym and we have to go through CPI because CPI just dropped and it is helping the market go to acceleration and beyond. Okay, but we have to talk about how this would help the market and why this is the core reason why markets are completely just rallying from here on out. Okay, so let's go through the report together. I actually went through the report slightly when I was in the gym, but I wanted to go through it via a video with you guys here as well. Okay, so over here you can see 0.4% in September over the last 12 months, 3.2% before seasonal adjustment. So we had different reports coming in with the forecast of about 3.5%, the highest being 3.7%. So to get a 3.2% year over year is pretty good. But something that we have to really take into consideration, which I think is one of the biggest part of it all, is over here, which is the core inflation. The core inflation actually went up by 0.2%, where most of the forecast that we actually get in the market was somewhere in the 0.3% mark. So I think only like 10% of the companies actually come out to say that, yeah, we are expecting it to be 0.2%. So a really big beat on core inflation, especially because the Feds are really hawk-eyeing this whole entire thing. They need to ensure that core inflation goes down. And of course, you can also take into consideration for super core, which is basically core inflation plus minus housing prices as well. But even then, if you were to actually do a super core, I'm pretty sure it's somewhere in the 0.22% range. So still pretty good. Okay, so let's go through this whole entire thing. Index for shelter continued to rise in October, offsetting a decline in the gasoline index and resulting in a seasonal adjusted index being unchanged over the month. So this is a huge thing because what we kind of expected from the whole entire Israel and Hamas situation is that oil prices would actually go up, which it actually did. And I already explained it to you guys on the channel before, which is that for this kind of conflict, usually oil prices will be volatile only for a little while. Okay, you are probably going to see the first 2 days, you're going to see oil prices go all the way up. And then immediately after, it's just going to just kind of waver downwards again. Okay, a lot of time it is not going to be very emotional trading, especially in oil. So I kind of expected it to begin with. So to see the energy prices actually go down for this month as a 5% decline in the gasoline index, kind of expected, to be fair. Okay, food index still going up by 0.3%. Again, I think this is always one of my most concerning part of the CPI, which is food prices. Again, like I said, because this is going to be affecting all the different families who are unable to afford cheaper food, you know, from Walmart, from Costco, whatever it is, and that's going to be affecting the standard of living in general. It's not even a quality of life thing, it's just a standard of living. It's going to be affecting those people who are making ends meet. Okay, so you can see the index for food at home increased as well. Even food away from home also increased, and we have constantly been getting increases for food. We have not yet gotten a single pause or decrease in food prices. But then again, you can also kind of argue the fact that it is normal because that's how inflation is. You are most likely going to have price increases over the years, over the decade. It's just that we haven't had any form of a de-escalation in terms of food prices. It has just constantly go up and up and up. And I think that's going to be affecting some of the lesser income families. Okay, so over here, you can see insane 0.0% for October. I think, hold on, yeah. Over here, yeah. 0.0% for October. I think this is insane for everyone to see. I think one of the most important CPI for us to really get. Okay, so now let me just open myself up so that I can explain to you guys. The chart is not important anymore. Okay, so let's talk about the Feds a little bit. Okay, for what we understand is that the Feds actually decided to pause the rates in the previous FOMC. So effectively, the Feds are going to be looking at all these different reports really carefully, because all these different reports are going to effectively narrate the whole entire story for the next year to maybe 3 years. Okay, And for this CPI, for that to be 0.0%, what this would actually mean is that there is a very, very, very high chance that the Feds would think that they don't have to raise rates anymore. And if they feel that they don't have to raise rates anymore, that's going to be super duper good for the economy. But let's not forget, the way you should actually look at inflation is that you should look at inflation like somewhat like an energy, okay? It cannot be created, nor can it be destroyed. It can only be transferred, okay? So now that inflation, the inflationary problem that we have in consumer prices, in all these different things, are effectively de-escalating, and we're starting to see a whole lot of disinflation. But you have to understand that when inflation goes away from one part, you have to go to another part, okay? Where it would actually go to is stock inflation. Effectively, the stock market is going to get inflated prices all over again. So you're going to see valuation going out of proportion. You're going to see Teslas, you're going to see Apple, you're going to see Microsoft, you're going to see all your FANG stocks go crazy. You're going to see all your tech stocks go crazy. You're probably even going to see cryptocurrency go crazy as well. Okay, so inflationary pressure would leave the consumer prices, and then it will go into all the different stock prices, asset inflation. Okay, so this is also a pretty good time for you to get into stocks, a good time for you to get into assets in general. So it could be bond, maybe you want to lock in that 10-year bond before it starts to go down. Maybe you want to lock into some properties if you're able to do so. Stocks in general, I think definitely you can kind of see a future moving forward, but again, for stocks, I am going to be a lot more cautious. And as I explained about this, I think 2 videos back, I think stocks, most likely we are going to see high volatility going up. And chances are we're going to see high volatility going downwards immediately after as well. And that's where I'm really, really afraid for stocks. So just take Tesla, for example. Tesla price at the moment is basically the same price as it was, I think, 2 years ago. Back in 2021 and 2023 of November, Tesla is priced exactly the same. And the business have actually, I think, 10 times. Earnings have went up pretty consistently at about 40 to 50% every single year. They have a lot more vehicles in production, almost 10 to 15 times more vehicles in production, and the shares are still the exact same price as back in 2021. And what that actually means, or what that would actually give the story to narrate it out, is that valuation is what the problem is that in 2021 stocks were overly inflated in price. People didn't care about valuation, people just wanted to get into the stocks. And that's where my fear comes in. Okay, of course, you can call it, FUD and all. That's fair. But I just think that stocks might be a little bit more concerning in the long run. And I think it's more like a 5-year period of time. We might actually see stocks remain unchanged. And of course, unless you're able to time every highs and every lows, you can get in on the lows to get out on the highs at every single point in time. Then, hey, you have a crystal ball, just not me. Okay, but I do think that stocks is probably going to be a little bit more concerning in the shorter to long run, maybe the shorter to mid run. I think in the long run, definitely, if you're thinking about holding stocks for 30 years, definitely stocks would still be one of the most strongest possible asset to have. But if you're talking about straight up just, in the next 2 years, I'll be really cautious about stocks. I will read up more about bonds. I think bonds would be pretty interesting. I would stay away from options, honestly speaking. I think options is going to be really dangerous in the next 1 to 2 years, simply because you're unable to really time on any of the volatility. Yes, there would be volatility coming in, be it high or low. We are unable to tell, simply because good news is not going to be reflected with good news. Bad news is not going to be reflected with bad news. And that's where you are going to see a lot of opposite trading happening. So I think options is definitely going to be a dangerous vehicle for you to really get into. I think bonds, be it as it may, it doesn't sound really fun. It doesn't sound like you can get huge returns. But of course, especially with this CPI that just came out, bond prices basically went down a little. Well, bond prices went up, which aka means yield prices went down. And when yield goes down, it means that you are going to be getting lesser on the dollar. But at the same time, if you're able to lock in for any of the 10s or any of the 2s, you might be able to get a good offer. You know, you might get a good bargain if this actually goes on the way it does. So I think that's going to be interesting for the next 1 to 2 years. But yeah, I think this CPI definitely one of the most important one yet, especially with what the Federal Reserve just went through the last FOMC. I am going to stay a little bit cautious. I'm not going to say that we're not going to be getting any sort of a, we're not going to get any sort of a rate hike anymore. But again, this really comes down to employment reports. For the Federal Reserve themselves, they're really worried that if they actually made the assumption that inflation is dead for good, or they actually defeated inflation for good, if that is their narrative and they want to go on with that, if inflation want to come back, they're going to get destroyed. Okay, people are going to hate the Federal Reserve so much. You're going to see people asking to change Jerome Powell, even as it is right now. Jerome Powell is already getting so much hate on the internet. So I think if he gets this wrong again, it's going to be just atrocious. But yeah, anyway, that's all for the CPI report. I thought that it was really interesting when I was in the gym going through it. But anyway, that's all I have for this video. Thank you so much for watching, and I'll see you guys in the next one. Peace out. Bye.